Allient Inc., ticker ALNT, massively beat Q2 2026 consensus estimates across the board.
Oh, and the market reaction was violent, just completely wild.
Right. I mean, shares surged nearly 17% in after hours, trading to $109.03. Then they blew past 111 the next day and eventually hit a 52-week high of $117.48 later in the week.
Which is just incredible for an industrial hardware stock. It's trading like a Silicon Valley AI darling right now.
Yeah, exactly. So let's hit the headline numbers first. Adjusted EPS came in at 80 cents, crushing the 61-cent estimate by 31%. Revenue hit $153.8 million, up 10% year over year, which easily beat the $145.7 million target.
And, there's a 9.3% organic constant currency growth rate buried in there, too, which is super solid.
Definitely. Now, on the guidance front, management actually withheld quantitative second-half guidance due to order timing.
Right, which usually spooks the market.
But not here. They issued this highly positive qualitative outlook, anchored by a record $298 million backlog and expected annualized cost savings of $5 to $7 million.
So those numbers represent a fundamental shift in how the market is valuing Allient.
Yeah.
But for you, the retail investor trying to navigate this stock, reading the headline beat just isn't enough. The real utility of this deep dive is understanding the mechanics underneath those numbers.
Because we need to figure out if this 17% pop is real.
Exactly. Is it a temporary valuation distortion, or is it the beginning of a sustained structural re-rating of the entire company? We have to look at the operational changes and the harsh cash flow realities of scaling a hardware business.
Right. So let's start with the top line. A 10% revenue growth is great, obviously, but a 17% violent stock pop, that's rarely driven by top-line growth alone.
No, definitely not in the industrial sector.
Right. Usually a reaction that aggressive means the market is reacting to bottom-line efficiency. It means they proved they can extract significantly more profit out of every single dollar that comes through the door.
And when you look at the margin profile this quarter, the expansion is just staggering. Gross margin hit a record 34.9%.
Up 170 basis points.
Yep. Operating margin widened to 10.2%. And adjusted EBITDA came in at $23.7 million.
Which yields a 15.4% margin. For a company that physically manufactures specialized hardware and precision motion equipment, achieving a 15.4% EBITDA margin is a massive profitability surge.
It's huge, and the driving force behind that margin expansion is this strategic overhaul management calls the STAN initiative, Simplify to Accelerate NRW.
Catchy acronym.
Right. But it goes way beyond just standard corporate belt tightening or reducing headcount. They are fundamentally rewiring their manufacturing footprint. The centerpiece here was the decision to physically shift assembly operations away from their Dothan, Alabama facility.
Okay, and move it where?
They're reallocating that production capacity to existing sites in Tulsa, Oklahoma, and Reynosa, Mexico.
Okay, wait, I have to push back here. They shuttered a major factory in Alabama. Isn't this massive margin expansion just a temporary accounting illusion?
How do you mean?
It seems like we're just looking at a one-off bump to the bottom line because they turned the lights off in one building and realized some short-term savings. It's like rebuilding the engine while the car is speeding down the highway. Is this actually a structural improvement to how the business makes money?
That's a fair question. But you have to look at the payback period and the recurring nature of the savings. Management is actively guiding for $5 million to $7 million in annualized cost savings over the next 2 to 3 years.
Okay, so that's recurring.
Yes. And they are generating that recurring year-over-year benefit against a mere $2 million to $3 million in one-time restructuring costs to physically execute the move.
Wow, okay. So the ROI on that move is incredibly fast.
Extremely fast. And moving production to Reynosa specifically gives them access to established cross-border electromechanical manufacturing hubs. It structurally lowers their labor costs while placing them closer to critical component suppliers.
Which brings down inbound freight costs, I'm assuming?
Exactly.
Yeah.
Meanwhile, centralizing other operations in Tulsa streamlines their domestic outbound logistics. So they aren't just saving on the electric bill in Alabama, right? They are permanently lowering the cost to build and ship their products.
Got it. So they spend $2 or $3 million today to permanently lower their operating floor and reap $5 to $7 million every single year going forward.
Yeah.
That drops straight to the bottom line.
Yeah, and if you look at the balance sheet, they aren't just letting that cash sit in an account.
Right. They used it to deleverage.
Immediately. They paid down $4 million in debt this quarter, which brought their leverage ratio down to a really healthy 1.63x.
So they are simultaneously improving operating profitability and de-risking the corporate balance sheet.
which gives them immense financial flexibility. But, the operational footprint is really only half the margin equation here.
Right, because of what they're actually selling.
Exactly. The other half is the product mix. Margins improved because operations got leaner, yes, but they also spiked because of a dramatic shift in what Allient is pushing into the market right now.
Yeah, the divergence between their internal business segments this quarter is just wild. The standout was the industrial segment, which jumped 17% year over year to $76.4 million.
And that's where the secret sauce is.
Right. Within that segment is the catalyst that set the market on fire. Their data center power quality solutions surged over 60%.
Massive growth.
And meanwhile, aerospace and defense posted a record $24.2 million quarter, driven heavily by drone demand. Even medical showed solid growth, hitting $21.8 million.
But then you look at the other side of the portfolio, right? The vehicle segment actually dropped 7% year over year, falling to $24.9 million.
Yeah, it was a drag on the overall consolidated result.
It was. Management attributed that to ongoing macroeconomic softness. Consumers are simply pulling back on discretionary purchases, power sports, ATVs, recreational vehicles, that kind of stuff.
Okay, so the vehicle segment, which is historically a core part of their business, is slumping. And suddenly, management is out on the earnings call highlighting 60% growth in AI and data centers.
Now where you're going with this.
I have to ask, as the skeptical retail investor here, aren't they just slapping the latest Wall Street buzzwords onto their earnings release to juice the stock? I mean, to distract everyone from the fact that people aren't buying consumer vehicles. How real is this AI exposure for an industrial parts manufacturer?
It sounds incredibly convenient, I get it. But you have to look at the physical realities of running an AI data center. We are so conditioned to think of AI as purely software, just code running in the cloud.
Right, just magic internet money.
Exactly. But the physical infrastructure required to train and run these massive AI models is bound by the laws of physics. AI data centers rely on tens of thousands of specialized GPUs running simultaneously, and when those chips draw power, they don't do it smoothly.
The pull-in spikes, right?
Massive, microscopic spikes of electricity.
Which creates dirty power.
It creates severe harmonic distortion. Those microscopic power spikes send electrical shock waves back into the data center's internal power grid. Yeah, if that power isn't perfectly conditioned and scrubbed, those harmonic shock waves create excess heat. And that heat can literally melt the insulation on wiring, cause breakers to trip randomly, or physically fry millions of dollars worth of sensitive computing equipment. You cannot run an AI data center on dirty power. The hardware will literally destroy itself.
And that is where Allient steps in.
Exactly. They aren't writing the AI software. They are manufacturing the heavy physical hardware, the harmonic filters, the line reactors that sit between the power grid and the servers to scrub those shock waves.
Right, they manufacture the precision metal and magnetic components that absorb that distortion.
Yes. And because the engineering requirements for AI power conditioning are incredibly strict, the barrier to entry is super high. You need specialized metallurgy and magnetic engineering, not just software code.
So these components naturally command much higher margins than, say, consumer power sports parts.
Exactly. Allient is executing a deliberate portfolio shift away from highly cyclical consumer-facing markets and pivoting aggressively into these higher-value, engineering-intensive arenas like AI infrastructure.
Okay, so with the product mix shifting so rapidly toward these high-growth sectors, the forward-looking pipeline metrics are critical. And the numbers here are arguably the strongest part of the entire report.
I agree.
They posted record orders of $201.3 million for the quarter. That translates to a book-to-bill ratio of 1.31x.
Which is phenomenal.
So for every single dollar of product they physically shipped out the door and billed a customer for, they took in $1.31 in brand new orders. The business is rapidly expanding.
And that massive influx of new orders pushed their total backlog to a staggering $298 million.
Up 26% year over year.
Right. But the raw number alone doesn't tell the full story. On the call, management detailed a fundamental shift in how they calculate that backlog. They have instituted a strict, much more conservative booking policy.
Okay, let's talk about the mechanical impact of that. Because industrial companies love to brag about massive multi-year backlogs to impress Wall Street, right? But half the time, those orders take 5 years to materialize, Or the customer quietly cancels them 3 years down the line. It's phantom demand.
Oh, happens all the time.
So management is now saying they will only count blanket orders that are explicitly scheduled for production within a rolling 1-year window. It acts like a strict air traffic controller. If a customer places an order but wants it delivered in 18 months, Allient is refusing to clear that order to land on the official backlog.
Yeah. They are keeping the runway entirely clear for immediate, tangible traffic. And that policy completely changes the quality of the $298 million figure.
It makes it real.
It makes it highly actionable. By refusing to count orders scheduled beyond 12 months, they are systematically eliminating that historical lumpiness and the phantom backlog risk that plagues this entire sector.
Right, which fundamentally changes how a factory manager operates, too. They aren't hoarding raw materials or allocating floor space for orders that might just evaporate in 2028.
Exactly. And for you, the investor, it means this backlog is incredibly reliable because the vast majority of this specific $298 million is expected to convert into physical shipments and actual revenue within the next 3 to 9 months. It gives highly reliable near-term top-line visibility for the second half of 2026 and early 2027.
Okay, so the demand is undeniable. But having a massive, high-quality backlog of physical hardware is a great problem to have. But it is still a massive operational problem.
Yes, it is.
It's like they've officially sold out the restaurant for the next year.
Yeah.
But now they actually have to cook the meals without burning the kitchen down. You can't just snap your fingers and digitally manifest $298 million worth of heavy copper harmonic filters. You have to physically build them.
Which brings us to the operational risks and the capital intensity of executing on this demand. To meet this surging data center and defense demand, Allient is being forced to spend heavy capital. They are currently projecting $12 million to $15 million in capital expenditures this year alone, specifically to bring new manufacturing capacity online. That new capacity is scheduled to ramp up right around late Q2 into early Q3.
And this is where the financial statements get a little tricky, right? There's a stark contrast right now between their GAAP profitability, which looks fantastic on the income statement, and their operating cash flow, which is visibly declining.
Right. They are having to build up massive amounts of physical inventory just to prepare to scale up this new production capacity.
So it's a cash drain.
Exactly. It's the classic mechanical reality of scaling a physical hardware business. It all comes down to the cash conversion cycle. If Allient books a massive order for data center filters today, they have to buy millions of dollars in raw copper, specialized steel, and electronic components right now.
And pay for it.
Yeah, they typically have to pay their suppliers for those raw materials within 30 days. But it takes time to physically manufacture the filters, test them, and ship them. Then, the end customer might not pay the invoice for another 60 to 90 days after delivery.
So they are bleeding cash up front to buy the ingredients, and they don't get paid for the meal until months later.
Exactly. During that entire multi-month lag, the cash is entirely tied up in inventory sitting on the factory floor. So while the forward-looking earnings and the profit margins look incredible on paper, the actual cash flow drops into a trough during this rapid growth phase. Management is currently navigating an intense working capital drain.
And they are doing it while under immense pressure from Wall Street. Because the stock popped 17% on this report, the valuation has stretched dramatically. The stock is currently trading at a price-to-earnings ratio of 65.4x.
Which is wild.
A 55 multiple for an industrial parts manufacturer is aggressive. That is software-as-a-service tech stock territory.
Right. The market is currently pricing Allient not as a legacy industrial manufacturer, but as an AI-adjacent growth stock. And when you trade at 65 times earnings, Wall Street is effectively pricing in flawless execution.
No room for error.
None. If that new manufacturing capacity they are building with that $15 million CapEx budget hits any unexpected delays, the market will react brutally. If the transition of operations out of the Dothan facility gets messy, or if they struggle to hire the right skilled labor in Tulsa, they won't be able to convert that massive backlog into revenue on schedule. At this premium valuation, there is absolutely zero room for operational errors.
Yeah, and they also have external macroeconomic factors to navigate while walking this tightrope. The sources note they're still dealing with lingering supply chain complexities and thorny tariff issues.
Right, the Supreme Court ruling.
Yeah. They're currently in the process of applying for refunds following a recent Supreme Court ruling regarding certain 2025 tariffs that impacted their imported components. It's just another layer of administrative and financial complexity they have to manage while trying to scale production at record speed.
But look, they have the orders in hand, and they have proven the STAN initiative can drastically improve margins. The singular focus now is purely on manufacturing efficiency, proving they can physically build the hardware fast enough to convert that mounting inventory back into free cash flow before the market loses patience.
The pressure is entirely on factory floor execution.
Yeah.
But stepping back, Allient clearly validated the earnings power of their new model this quarter. I mean, the combination of structural margin improvements through their operational realignment and their aggressive, highly successful pivot towards supplying the AI data center and defense markets, it created a perfect storm for this earnings blowout.
It was enough of a fundamental shift to prompt major analysts, including JP Morgan, to immediately raise their price targets to as high as $120 a share. Yeah, the underlying fundamentals justify the market's enthusiasm, provided management can successfully navigate the intense cash flow constraints of this rapid expansion phase.
Yeah.
Because the demand for industrial-grade power conditioning in the AI era is not a passing trend. It is a structural, physical requirement for the next generation of computing.
Which leaves us with a fascinating dynamic to consider. Everyone is obsessing over the microchips, right? The companies designing the AI brains. But if a specialized, relatively unknown precision motion and controls manufacturer like Allient is quietly seeing 60% growth just from building the surge protectors for these data centers, what else is out there?
Oh, so much.
Right. Who is making the specialized liquid cooling pipes, the reinforced cabling, the industrial-grade transformers required to keep this massive infrastructure from melting down?
Yeah.
There's an entire ecosystem of boring, heavy metal industrial stocks secretly acting as the foundational infrastructure for the AI revolution.
It's the picks and shovels of the AI gold rush.
Exactly. Well, if you want to stay ahead of the market and find out where the numbers are pointing next, make sure you follow the show for our daily earnings coverage. We will keep dissecting the financial realities of these reports so you don't have to. Navigating this market requires understanding the murky, complex operational machinery humming beneath the headline numbers. We'll catch you on the next deep dive.